The reason that's a problem is that Morrisons competes with other supermarkets on price, and now it has to pay hundreds of millions of pounds more each year in interest payments.
Remember that little shop we talked about earlier and how its purchase was financed with a lot of debt?
In the case of Morrisons, it was something like £6.6 billion.
Here's the important bit. When CD&R bought Morrisons, interest rates were low, but since then, they have increased.
Around half of Morrisons' debt, that's around £3 billion, is affected by interest rates going up. So that debt is now much more expensive.
The reason that's a problem is that Morrisons competes with other supermarkets on price, and now it has to pay hundreds of millions of pounds more each year in interest payments.
They were just about making enough money to pay their debt, which meant that when Aldi and Lidl came in during a cost of living crisis and cut prices, Morrisons simply couldn't keep up with them.
That's helped Aldi overtake Morrisons as the UK's fourth biggest supermarket.
To deal with the suffocating debt load, Morrisons has sold assets, including a £2.5 billion deal for its petrol stations in January. It's hoping that will let it offer lower prices to shoppers.
These problems are besetting a lot of the businesses that private equity has bought.
All of this really matters because private equity-backed companies employ 1.9 million people in the UK, and their suppliers employ another 1.3 million people.
So when these deals go wrong, it can have real-world impacts. So it can mean higher costs of goods for consumers, and we can also see jobs lost.